Okay, so we have an example of the Fisher effect. So, pretty absurd example, but anyway, if we require a 10% real return and we expect inflation to be 8%, what is the nominal rate? So, using the full Fisher equation, it's also referred to as a precise measure. So it's 1 plus the 0.1 or 1.1 multiplied by 1 plus the expected inflation of 0.08, and minus 1 would give us 0.188 or 18.8%. So we can do the approximation. So it's just the nominal rate is 10% plus 8% or 18%. You can see that this is since rates are relatively high, there is quite a big difference, but 0.8% between the actual Fisher effect and the approximation. So the determinants of bond yields. The term structure is the relationship between time to maturity and yields, all else equal. It is important to recognize that we pull out the effect of default risks and different coupons, etc. For the most part, when we look at a yield curve, we're looking at U.S. Treasuries, and we're looking at default risk on various treasuries, not default risk, the relationship between yield and time to maturity. So that represents the term structure. A normal term structure is upward sloping. Long-term yields are higher than short-term yields. An inverted structure is downward sloping. Long-term yields are lower than short-term yields. This usually is an indication of a recession. So we can also have a flat yield curve as well. We've recently had some inversion with I actually haven't looked in a little bit, but the difference between the 10-year Treasury and the 2-year Treasury, that spread, if it goes negative, that's also a predictor of a recession. So factors affecting required return: default risk premium, bond ratings, so forth. The lower the bond rating, the higher the default risk premium. Taxability premium. So we talked about municipal versus taxable. Liquidity premium. Bonds like treasuries will have a very, very small liquidity premium. Treasury bills, for example, will have the smallest liquidity premium of them all. So, but bonds that don't trade as frequently will have a higher liquidity premium or a higher bid-ask spread. So anything that affects the risk of the cash flows of bondholders will affect required returns. So, think of Detroit or Chicago having financial problems. Those are going to raise the investors' required returns on their bonds and reduce those prices. So that is the end of Chapter 7.